NYMEX natural gas found buyers in early Friday trading after Thursday's EIA report showed the smallest injection relative to the 5-year average in several weeks. The weather outlook is also giving the bulls something to work with. Forecasts now extend into early September and continue to show above normal heat across much of the lower 48. That gives the weather trade more time to build than it had on Monday, when cooler model runs sent prices sharply lower. However, prices retreated toward $2.75 after Baker Hughes reported only a 1-rig decline in the active rig count, leaving the total at 127 rigs. That is still a pretty high number considering the current price level. And the bigger issue is associated gas. Permian oil production continues to generate plenty of natural gas, while the major shale basins have yet to meaningfully respond to lower prices. Every natural gas rally this summer has run into the same wall of production before it could develop into a sustained move higher. That is the main reason bulls still cannot break through the $2.80 barrier. However, there is another side to the story. Despite all the bearish pressure, natural gas has still failed to settle below the $2.70 support level. More importantly, since the beginning of August, the market has continued to form a series of higher lows. One potential reason is the changing geopolitical situation in the Persian Gulf. Iranian President Masoud Pezeshkian has said Tehran would prefer to end the war while remaining in a position of strength, describing the existing memorandum with Washington as a victory for Iran. Meanwhile, Trump has apparently decided that if you can't win a war militarily, you can always rename it a financial war and declare victory from there. A creative strategy, if nothing else. If tensions ease and the Strait of Hormuz can eventually reopen, oil prices could come under significant pressure. And lower oil prices would matter for natural gas because they could eventually reduce the incentive to keep drilling for oil and, consequently, producing associated gas. Well, apparently the Strait of Hormuz can be reopened soon, which means oil prices are destined to fall not only because those missing barrels can finally return to the market, but also because Trump is presumably smart enough to realize that sky-high gasoline prices right before the November midterm elections would be, let's say, a brilliant way to help the Republican Party. So we could eventually see a very interesting setup this fall, lower oil prices and declining associated gas production arriving at the same time as the start of the heating season and the ramp-up of new U.S. LNG export capacity. That combination could create a pretty powerful bullish storm for natural gas. The big whales may simply be waiting for a few more pieces of evidence before diving back into bullish waters. Technically, natural gas remained trapped in the $2.75 to $2.80 zone on Friday as traders appeared reluctant to make a major move ahead of the weekend. That means Monday's weather updates could become the next major catalyst. If natural gas finally breaks and holds above $2.80, the next target would be the 50-day moving average near $2.92. A sustained move above the 50-day MA would then open the door toward the $3 resistance level. That said, I don't think we're quite there yet. For now, the most realistic scenario remains consolidation between $2.70 and $2.80. Natural gas bulls have the ingredients for a bigger move, but apparently, they still need to find the recipe. If you're looking for a more detailed breakdown of the market, consider joining the channel. Members get early access to new videos, so you can see the analysis before everyone else. Thanks for being here, see you in the next update.